It's not the holiday season. This is Christmas time. We're not going to say happy holidays.
I think all the new habit-based resolutions are 99% stupid. But they're not stupid habits to want to do, but it's to try to have this set date.
If you do it correctly, buying insurance is not an expense. It is safe.
We want to basically wrap up 2025 and start thinking about 26. It's always a good time to revisit all of your assumptions, revisit all of your current strategy. Just keep stress testing. We talk about that constantly. You should always be doing that. But this is always I like, people always talk about New Year's resolutions, and I know almost nobody that says they do New Year's resolutions. It's like people always talk about how they don't do New Year's resolutions because it's too cliche to have resolutions. Right. But honestly, I kind of like it. I coming into the end of the year, like I'm going through all of my appointments now, looking back at the business over the last year, trying to find any loose ends, reach out to people that I've had conversations with that either dropped off or I just haven't hit up in a while. And so I'm looking at my tax situation. Like this is the point where this is the time of the year that I really do like to focus and tighten everything up, tie up all loose ends, move forward, and then get ready for 2026 and actually have, I do like New Year's resolutions. And I feel like that's now the unpopular convention.
Yeah.
Because everyone's anti New Year's resolutions, but I like them. I want to be ready for the new year, but I want to go in now in December. I want to be planning for what we're going to do. And it doesn't mean kick your feet up and just stop working and stop trying for December because it's the holidays, or it's the one holiday. It's not the holiday season. This is Christmas time. We're not going to say happy holidays. There's one holiday happening in the month of December.
When somebody says happy holidays, you know what their frame of thought is.
There's one actual holiday happening in December. There's a very minor and insignificant Jewish holiday that happens in December. It's not really like a big thing. I mean, it exists, but it's not a big thing.
It exists, but it's not. It's not on the scale of Christmas. In the Jewish tradition, It's not on that scale. It's not the holiday.
There's a fake one made up in the late '60s by a sociology professor that just celebrates African harvest. Like Kwanzaa? It's not a real. Yeah, it's not a real thing either. 1966 sociologist professor just created it. But no, that's not a thing either. Like this is the Christmas season, and we will say Merry Christmas. So
I'm right there with you on that. I love the New Year's resolutions in the sense that it's a great time to reflect on the year that's passed. It's a great time to think, well, here are the things that I would like to accomplish next year. Here are the things that maybe I fell short on this past year that I'd like to do better on next year. So I like it in that sense when you're mindful about it. I think the reason everybody's so anti-New Year's resolutions now is because, like, everybody, like the mainstream, like I'm talking from a mainstream culture perspective, like their New Year's resolution was always the same thing. And that was like, I'm going to go to the gym 5 times a day, and I'm going to stop eating Oreo cookies at night, and I'm going to, whatever. And that was it. And then it lasts 3 days, and then they go right back to whatever they were doing before. And I don't knock that for people who do have health or fitness goals, but you've got to be mindful about it, and you've got to be meaningful. I'm reading the chat here. Brian said, "What about Festivus?" Now that is a real holiday. I can get behind Festivus with in the old sign.
I got a lot of problems with you people.
I love it, man. I remember Seinfeld. I probably watched every episode back in the 90s. That was like one of the best shows ever.
Yeah, my thoughts on that resolution stuff is that
classic.
That they're stupid when it's about changing a habit. Like what you're talking about, Hans, to me just sounds like, hey, I'm goal setting and I'm thinking about like what I've done, reflecting on that, and what I'm planning to achieve to keep growing in what I'm doing or to do it better, maybe based on this experience. But what you're talking about, Joe, and the reason I reject that is if you wanted to change, like if you say, man, I'm going to start getting healthy and I'm going to stop eating junk food after I gorge for the holidays, you really don't have the mental state to start.
Right.
Like because if that was important to you, you would just start. You wouldn't need it to be like next week. You would be like,
you would just do it. It's not about
done.
I'm going to give up something I want to do. It's about
that's right. Yeah,
I don't want to do
I
it,
think
so
all
I'm not going to do
all
it.
the new habit-based resolutions are 99% stupid. But They're not stupid habits to want to do, but it's stupid to try to have this set date. Like, just do it. If that's what you want to do, just do it. Yeah.
Right. Just do it.
Yeah. Start December 17th if you're going to get in shape. Like, but if you put numbers on it and have a definable goal, and we've talked a lot in the past about if your only metric, like if you don't have a specific metric in mind, your only target is more. Financially speaking, that's a common thing. It's like if you don't have a number you're shooting for, like I want like Remnant Finance in 2026, I want to be $1 million business. That's a tangible goal and a number we can work for and a number we can measure ourselves against. In 2025,
you know where you are.
Exactly. I said in 2025 I'm going to do 10 pull-ups a day as a goal, just like one of a fitness related goal. And I haven't done every single day, but I've made up for the days that I haven't. And so 2026, I'm going to do 5,000 pull-ups on the year, however it's allocated. But like that's a number I can shoot for, and I like having something I can check off the box and make noticeable progress towards, and I just keep track of it on my wall. And so I do like those kind of resolutions, but yeah, it's not just like I'm going to get in better shape this year. That's going to fail. But I'm going to do 5,000 pull-ups in 2026. I'm not going to fail at that. I'm going to make that happen.
Tangible and measurable. That's one thing that that our marketing industry got right in this country. And they were the ones who figured out if you can measure something, you can improve it. And what we measure will get better because we're measuring it. And by the act of measuring it, it means we are aware when it falls short of where we want it to be and we can take corrective action. So yeah, what you measure gets better. So tangible and measurable are the keys, I think.
Yeah, no. So Joe, this is your ship to steer here. How do you want to generally proceed? I mean, we're going to have a conversation about sort of our financial framework. We'll talk about some goal setting things we want to put in place, and then have some Q&A. So where do you want to take it?
You know, I just wanted to hang out with everybody. So I'm excited to be here. Thanks everybody who's joined us tonight. We're doing a joint strategy session here. We've got the Remnant Finance team, which is Brian and Hans, who I know for our guys at the Phoenician League, you guys are household names. So these guys do great work with what their areas of expertise. There are IBC, infinite banking concept, cash value life insurance experts, but they're investment experts as well. They are investing in a range of asset classes. They do great work for their clients with regards to basic personal finance as well. And so just great guys. I'm just honored to have gotten the chance to know you over the past several years. I'm honored for the partnership. I'm grateful that we get the chance to hang out and do things like this. And so my thought for this evening really was just, for those who are looking back on 2025 and those who are looking at 2026 and thinking, well, this is the year I'm going to take my financial strategy to the next level. I'm going to shore up my finances. I'm going to, really start to execute upon these things that maybe I've been putting off or maybe I've thought, that I really should be doing, but haven't done as much as I should. I just thought we could get together and we can talk about what that looks like from a basic framework. And I say investing, but really, the core of it is savings. The more I research, the more I read, the more I learn. And I know you guys have done a lot of the same head work, and you're in the same mind space. If you look back to, really, it was the 1970s that there was legislation written that basically created what I call Retirement Incorporated, Retirement Inc., like the industry of retirement. And it didn't really roll out, I think, in practice until the 80s with the creation of 401k plans and then IRAs and then all the other variations of IRAs for different, people in different employment types or whatever. But what that did was it convinced people, basically, it tricked people to not save money. So if you look at our society today, people don't save money. They think their 401k is savings. They think their IRA is savings. And of course, they're told, back in the early days, everybody was told to buy mutual funds. Today, it's not mutual funds. Today, it's like a triple leveraged 3X, ETF of some kind, like the most financialized, instrument available. And so people are taught just to pour their what they consider savings into the market, into these vehicles that are managed by some company that they don't know. There's a fee structure that they're not aware of. And maybe it works out okay, maybe it doesn't, but it's not saving money. And so that's one thing I really wanted to hammer home as we get into 2026. I think, and we talk a lot about advanced investment strategies, and that's the fun stuff. That's the exciting stuff. But you can't do that, or at least you should not do anything advanced until you have a solid financial foundation in place. And so that's kind of what I wanted to really hammer on tonight, at least for a little bit, is what that looks like. And I know you guys have a moniker. What is it? Save, protect, grow. I think it is.
Protect, save, grow.
Protect, save, grow. And it's in that order, right? And I think order of operations are very important. And so that's kind of where I wanted to start tonight. So maybe would you guys share with us kind of your thoughts on protect, save, grow and what that means for you? And maybe we can, kind of have a conversation from there.
Yeah, for sure. So protect, save, grow in that order, because the subsequent one is less important if the previous one is not in place, and each one can be successively derailed if you haven't put the framework in place in that order. And so when you go sit down with a CFP, the first thing they're going to tell you to do is most likely, and I'm going to be generous here, and my experience, I have not had this conversation go this way, but being as generous as I can, it's going to basically be buy some term insurance so that you don't leave your wife with a mortgage that she can't pay off. Cover basically, maybe get a $500,000 term policy just to cover the bills in case you die. It's an afterthought. It's kind of a check in the box. It's a necessary expense. Leave your wife a little something in case something happens to you. But you're going to live a long in life, and you're going to invest, and you're going to grow your money. And the market's going to average 11% a year. And you're going to have this wonderful mountain of money to retire on down the road. Now let's think about an emergency fund. You maybe save $10,000 in case you need to replace a leaky roof. But that's also sort of an afterthought. Just emergency fund, just enough that liquid cash that you could use if you need it. And now we're going to spend all our time focused on growth. We're going to invest the money, and you're going to do that in index funds or mutual funds if you're Dave Ramsey and haven't updated your advice in 30 years.
In 30 years.
And so, like you said, mutual funds are mostly
local paper, by the way. I don't know what type of arrangement they have, but this guy, like stuff he wrote 30 years ago, is being published in my local paper. And I read it, and like if you're have done no financial planning whatsoever, some of the simple stuff is actually pretty decent advice. But beyond that, it's like this guy is not he's not somebody you really want to build your financial fortress around. But anyway, sorry for the interruption.
Yeah, so outside of small town local newspaper, 70-year-old guys giving financial advice, or outside of your financial peace university, no one's doing mutual funds, I would say. It's index funds for the large majority of what people are put into when they're talking about this growth. And so that's great. You want the low-cost index funds if you're going to be investing in the broader market, and people can't beat the market. So I get a lot of the talking points there. But that mutual fund, that ETF, if you don't make it to that age 65, it truncates where it's at. It's not a self-completing product. You don't guarantee that future value you're looking at is going to be there. And so if you can't guarantee that the growth component is going to be there, because one, you don't control the markets. Two, you control your actions within the markets, which are often suboptimal if you're going in and going out, selling at the wrong time. And the markets themselves, you don't control at all. And so the down years are going to impact your principal in a way that's going to take a much larger leg up to recover where you were before the down year.
And they never talk about that either. Like they share like 7-8% a year. And that is the average, but that's not entirely accurate, because if you have a 20% down year and then you make 7% the next year, well, you're still down, and you're still down pretty significantly. And so
we have an episode on that.
They very much whitewash things, and I think it's disingenuous in a lot of ways, and how they, kind of the mainstream retirement incorporated, how they pitch this idea of financial education, I think leaves a lot to be desired.
Yeah. We've looked at, and we have an older episode. We should probably hit it again, but the average rate of return is a data point that's totally irrelevant in financial planning if you're doing it honestly. It should be thrown out and never considered, because it doesn't reflect reality. I've taken every 30-year snippet of the S&P 500 since inception and looked at the average rate of return as calculated by your CFP when you see that growth chart. and then you take the actual compounding rate of return, what your actual experience would be over that same time frame with perfect hindsight information, and you never make it more than 2/3 to the way of what you would have had you always had that perfect compound growth curve. So if anyone's telling you average rate of return, if they cite, and that's why this planning conversation is kind of stupid in my opinion, when it involves something like, well, if you put your money in the market and the market does X per year, then you'll have this much when you retire. It's like, okay, maybe, maybe, who knows? You don't know, I don't know. And even if we have that perfect hindsight information, it's not going to result in what you're showing me here. It never does. There's not a single 30-year snippet where that goes. So, yeah, generally, if we can poke holes in it, and what we call it stress testing your strategy, if we can poke holes in it and say, what if X happens? Does your plan survive contact? And if we can, typically, you can come up with 10 different things. What if you get disabled? What if you die at 32? What if you get laid off and don't work for a year and don't put any money into these plans? Like, does your plan survive contact? And it's often no.
That was the Mike Tyson quote, right? Like, everybody has a plan until they get punched in the face.
Right.
And maybe I shouldn't. Mike Tyson's probably not the best role model, but from a purely, like, if you just look at his career from purely a career standpoint, the guy was pretty impressive because he had everything going against him. Like, he was a relatively small guy as far as boxing goes, but he put in the work, regardless of all the other things. But anyway, that was.
Yeah.
So, does your plan survive contact? And Mike Tyson said, "No, it's not going to."
Joe, that little, I had the little discussion with you on the parallel paths of wealth. And that covers really the whole protect, save, grow. I think in a really great sequence. If most people here are watching, I can kind of draw that out, which I didn't have the opportunity to do with you last time. Let me see if I can.
Yeah, that'd be great.
Share the screen here.
While Brian's setting that up, one thing that I think resonates with both of our audience, which now has quite a good bit of overlap, and the way that Brian found you, I believe through Tom Woods and the libertarian school of thought, a lot of us resonate with the idea that the COVID hoax was a total scam. In my opinion, 100% start to bottom, start to finish was a scam, right?
That. Yeah.
And Brian and I met through fighting the mandate with the military, right? And so it's no longer like this theoretical thought experiment of what happens if something disrupts your income. So when we talk about those what ifs, what if you get laid off for a year? What if you get benched from flying because you refuse the shot? What if you get kicked out of the National Guard, no points, no pay? Like, we have so many clients that I'd say 70% of our clients were from the military mandate fight at this point in time. That's about how many I would say. And so everyone has an experience, either directly or through someone they know, especially through this network, of my career just went totally off the rails. I was going to do 20 years in the Navy flying, no question, right? And that's gone. So like, these what if questions are real. And I think that the last 5 years have exposed many of us to the idea that, hey, we need to think deeper about this than just, I will be doing this career path for 20 years.
Yeah, you never know. You never know. And so we need to account for the fact that the future is unknowable. And this is where I've been influenced by the late Harry Brown, who ran for president on the Libertarian Party ticket in 96 and 2000. Very eloquent guy. But he was an investment guy before that. He spent his career in the investment markets. And that was his whole philosophy for the investment for investment strategy was, we cannot know what the future holds. Therefore, we need to account for any possible future, and we need to incorporate our strategy to make sure that we're robust, given that we can't know what tomorrow brings. And I think that's,
and let's look at why.
Just kind of basic wisdom.
Let's
do it.
This kind of, I don't know, I'll call it talk or was shown to me by a guy named Vince Sedona, and it really just wrapped up everything we talk about in that protection, savings, growth model, put it all into a great summary, and it crushes. So I'll give my best version of it. Let me know if you can't see the screen or anything, or if anything's coming out weird, but perfect. Everyone we meet
right now, I'm just seeing black.
Has to be on two parallel paths. on, eraser. Hang on. There we go. So, all right, it's coming through.
There we go.
All right,
With
so
you,
everyone
Brian.
we meet has to be on two parallel paths. The first
Yep.
path is the protection path. And what I mean by that is protection from liability, disability, and death. So let's jot those down. So any kind of liabilities, any kind of disabilities, and of course, the ultimate thing that will crush is death. And really, that's about the type. It's about the amount and the position of that protection. Let's keep writing here. How about we go type, amount, and positioning of those protections. So the second path that we're all on is the wealth accumulation path. And that really, it's all about capital. So that's going to be capital for short-term needs and capital for long-term needs. Short-term needs could be something like funding college, buying a new home, retirement, any one of those. That's also part of a long-term need. But the reason why you have to do both of these is because of the way that wealth grows over time. And we all know that you don't put $10,000 into a marketplace somewhere and automatically become a millionaire. So maybe in a business this can happen fast, but for the majority of people, that wealth is going to follow some sort of curve, and it's typically drawn like this with a parabolic curve. And it happens over the length of this entire, if you consider these your lifetime, these parallel paths, that wealth accumulation is going to occur over that time. So if it's going to take time, you got to deposit money over and over and over to get that return. So your wealth accumulation is really most effective later at this tail end of that. When you think about compounding returns, what you do today has its greatest effect in the very final year before you die, or in the very final year before you retire. But the problem is you have to start that today. The big effect happens in the savings later. The problem is you don't own that curve. You don't even have a right to that curve. And there's all sorts of things that can interfere with having that curve. So in the chat, for example, what are some of the things that can interfere with that curve?
That's it for anybody. Anybody, just throw it out in the chat if you would. What can interfere with the wealth accumulation curve? We'd love to invite thoughts. Diana said depressions, inflation, etc. Robert said taxes. That's a big one. Doggone taxes. I was excited when the Trump people came out and said we're going to cut $2 trillion and we're going to have tariffs and we're going to get rid of the income tax. And I was like, yeah, let's do that. And I haven't heard much about that recently. I'm a little disappointed. But Jim says disability. Rhonda says sickness. Diana, infinite money printing.
So I'll just put fiat for that. I think I missed a couple in there. Getting fired. So, yeah, that's a good one. How about job loss?
Getting fired. Yeah, Daniel.
The 3 Ds that I talk about, I'll just add a couple here. How about divorce, disability, and, of course, death? I think we've kind of hit the idea there. AI taking your job. Yeah, absolutely. Job loss.
AI taking your job.
So all these things, absolutely true. Health issues. Yeah, so thanks for sharing all those. And you see, they're like the reason why we protect first is to assure ourselves of the probability of having that curve materialize over time. So how many of those things, we listed like 5, 6, 7 things there. How many of those have to go right to have the curve work out? Yeah, or all of them.
Pretty much all of them.
How many of these things have to happen for that curve to fail? Yeah, just one. So all of those have to happen, or any single one of those can completely disrupt that curve. So protection is absolutely necessary to assure the probability of that curve happening. That's what the empirical evidence shows us on that. So I would say that if I could take all of our clients between Hans and I and put them in a room, they'd probably tell you that they would rather have a 100% probability of getting to 95% of their target wealth rather than the possibility of getting to 100% and the likelihood of getting somewhere far less, something like 50%, because one of these is probably going to happen. And, you know, that's what we've learned with across this industry and hundreds of thousands of man hours and tens of thousands of cases over decades and decades, is that if you're not protecting first, your wealth will be disrupted. So, you know, what do you think of that?
Unless you just get really, really lucky, which can happen, but you know, why take that chance?
Jim added a good one here, that poor investment decisions.
That's probably the biggest one that I see
Yeah.
from people, and it's usually speculating, you know, with some idea that came up somehow, and somebody said, oh, if you do this, you're going to make, you know, 10 times your money or whatever. And so somebody puts way too much money into the investment idea, and then it doesn't work out. And I've seen that quite a bit, just with the poor. It's almost like self-sabotage. But at the time, it doesn't seem that way. At the time, it seems, you know, it's usually it's presented as, oh, this is
This would be great.
You know, this is a sure bet, man. This is the greatest thing. This is the best investment. And you know, if you notice, like, especially if you look at, you know, marketing around some of these things, it's always like, and you got to do it right now. Like, you can't wait till tomorrow. Like, the opportunity's now. You know, that the urgency that's created around some of these things. And I don't know if that's what Jim is getting at or not, but I've seen that a lot in my career, that people have put way too much money into speculative ideas that did not work out.
Yeah, and just if you look at assign a percentage to each of these things, you know, your chances of, for instance, disability at a younger age, like getting disabled early versus dying early, those two things could both happen, but statistically, you're twice as likely to become disabled than you are to die early, right? And so those are both things we want to counter against, but we want to be thinking about both of them. Infinite money printing, clearly, they're not going to stop creating more money, and Congress is the bad guy here. I mean, we always beat the Fed, but they're kind of, at this point, monetary policy is reactionary and trying to keep up with fiscal policy. It's like you pull off the mask of the Fed. If we're talking about the bad guy, it's the Treasury. Then you take off the Treasury mask and it's Congress. Like, they're the root cause of this. And so that's where the anger needs to be. But ultimately, as long as they keep printing, as long as Congress keeps spending more money than they're taking in, which they are doing every single year, regardless of the administration, the Treasury is going to have to keep creating auctions for Treasury debt, and the Fed is going to backstop what they can't sell. So at the end of the day, the money supply is going to, that's 100% chance it's going to keep happening. And they've indicated that not only, you know, all the excitement we got over, you know, Doge and stuff, like, not only are they not going to trim the budget, they're going to massively just cannon a much larger hole into our national treasury, right? But poor investment decisions is, I think, the most interesting one in there, because a lot of things are like, a lot of us can get by without getting disabled, without dying early, without divorce. Infinite money printing, that's going to happen regardless of what we do. So we need to understand it and be prepared against it. Getting fired, that's a higher likelihood. I'd say we have a lot more experience with that over the last 5 years, a lot of us, than we would have told you if we had gone to 2019 and said, what are your chances of getting fired? You told me I'm pretty much locked into a 20-year career in the Navy. Like, no question, right? Yeah. So, but this poor investment decision is something that is so prevalent. Unless you are the most boring investor and you just buy, you buy, you know, you DCA into index funds every month, every year,
DCA,
whatever.
Dollar cost average, you know, investing the same amount of money every, every on a fixed period.
You never look at it. You never make decisions based on the price. You're just boring. You're simple. Maybe you buy the dip, but you don't change anything. If you're not that person, you're very likely going to make poor investment decisions. Like, oh, look at this. Everyone's rushing into GameStop. Like, how many people bought and participated in some way in the meme stocks of 2020? Even people like I did. Like, I'm not, you know, it was like, oh man, this is crazy. Like, buy some options here. And I made some money on it. And then I lost that money. And so poor investment decisions, I think that is the tendency to do the opposite of what you should be doing, which is buying high, buying the hype, and selling low, selling into the fear, you know, the buy when everyone's, sell when people are greedy, buy when people are fearful, et cetera. Like that is, we all understand that, but can we do that? Can any of us look over the last 5 years of investing and say we didn't make a decision that we know is bad, or as Diana just said here, or LSO, right? So a lot of us are doing this options trading. We have a group of 25 or so clients of ours that have joined options trading, and we have our own little chat where we're, bouncing ideas off of each other. Hey, what did you do here? Has anyone ran into this glitch or anything like that? It's a way that we can ask all the questions we want to ask without getting hammered by Troy in the community section, right? But it's funny. Everyone joins. Everyone's excited. 1% a year is like this. We're excited. Or sorry, 1% a week. Sorry.
It's like I don't know what kind of game you're playing. But that's not what I'm doing.
Yeah. Yeah. So like we're excited about it. This is a conservative framework. Just follow the framework. Everyone follow the framework. Follow the framework. Follow the framework. Right. But then, without fail, our guys join, and mostly they're pilots, mostly alpha. Like, let's do this, and they come in. They're like, okay, here's the framework. I get it. I'm done with the core training. Now let me push the limits. Let me try to get 2% here. Let me try to get 3%. And it's like, if you could look at the history of this chat, it's just a case study in follow the framework, because it's like, all right, I'm going to try this where I put a little more of my capital in this one position. It's a boldly Bitcoin play. It's a little more aggressive. I'm going to shoot for 3% here, and then I'm going to do this, this, and this. I'll report back later. And then later comes, and later is, shit, I should have just followed the framework. Like, that is over and over, and every new guy that joins in. So I feel like we have hopefully enough of a body of failed experiments where it's like something like that. There's a framework built. The path to getting 1% a week is simple and clear and repeatable, even in down markets. And despite these errors, most of us are still getting that 1% a week. But after a couple months of doing it, it reinforces like, hey, all right, here's something that works, and I'm just going to do this simply. I'm going to be as simple and boring as possible. I want to get to where John is. For anyone that follows the low stress option, he just checks it once a day, doesn't think about it, doesn't stress. I initially started on the other side of that, where I'm constantly monitoring, moving these positions. And now, we've seen enough guys that just get themselves into trouble by being too aggressive. So I think that poor investment decision that Jim G pointed out is kind of, it's one that might not show up on if we just asked an audience to list these things, that might not come up on most groups, but that was a really timely one that we should all know that will disrupt that growth curve faster than anything. And statistically, it's way more likely to happen that way, that you freak out and panic sell, or you get sucked up in hype and panic buy, FOMO buy. That's way more likely than disability. And that's something we should really account for.
Yeah, and if I can just piggyback on that, you talk about being boring and systematizing, you're at least creating a financial foundation. Something I do, and something that we advocate in the Phoenician League, is every time you get paid, every time I get paid, I move a little bit of money into gold and into Bitcoin. Without question, without fear. I don't even check the price. I don't care about the price. I just move some of the money into gold and Bitcoin. And I do it every week. If you get paid every 2 weeks, do it every 2 weeks, whatever it is. And whatever amount of money that is to you is not as important as just doing it every week. Because if you do this every week, you will be amazed at how much you accumulate over time.
That's true.
And I was tempted to say how much money you accumulate over time, which is true, but we tend to price these things in dollars. And what I always, strive to kind of present is that I do not care about the dollar value of gold or Bitcoin. I don't care. Because I invest in gold and Bitcoin. Not even invest. That's not the right word. That is the word that people use. But I don't see it as investing. I see it as saving. I move dollars into gold and Bitcoin because I don't want the dollars. I don't want to save in the dollars in this capacity. I want the gold and I want the Bitcoin. And I am very, very, very confident that both will be more valuable in dollar terms in the future. And that was always the case. But we're in a situation today where I do believe, and my analysis and my research suggests, that the U.S. government is actually adopting gold and Bitcoin as strategic assets.
I think so too.
At the national level, which is not why we got into them. In fact, kind of the opposite reason why we got into them. But they're doing it. And that means they now want the price to go up. And they're going to try to kind of let some steam out of the, out of the debt situation via via both of these assets, it creates optionality. But the days when I remember when early in my journey, people were worried about in 1933, FDR made gold illegal, and they had people call it a confiscation. It wasn't actually a confiscation. It was just like they told people you had to turn your gold into the bank and you got paid for it. Then they revalued the gold higher after they got it. But in the early days, people were worried about gold confiscation, and we were I was early in the Bitcoin space, and at one time we were worried about the legality of Bitcoin and the self custody and all these things, and we're in a place today where both are supported. Gold and Bitcoin are supported by the U.S. government in a somewhat ironic series of events. But anyway, those for me, that's every time you get paid, I think it's wise to move a little bit of money into gold and a little bit of money into Bitcoin. For gold, you can use the United Precious Metals Association. When gold was $800 an ounce, wasn't as hard to buy an ounce of gold every now and then. But with it $4,300 in change today, it's easier if you use the United Precious Metals Association. You can buy gold in roughly 1/70th of an ounce, which is, I think today's like $80, something like that, is the smallest denomination. But it allows you to build a gold position. And of course, they have audited, allocated accounts that are set up in a trust to where you can, if you build gold reserves in the United Precious Metals Association, which is UPMA.org, you can request delivery at any time. They'll send you the gold. So it's very much, it's not, this is not a buying an ETF that's not, marked for delivery or anything like that. It is very, very traditional in that sense. But that's an easy way to do it. With Bitcoin, I just use the Cash App. I don't know if you guys have that one. It's the easiest one. Just use the Cash App. You can buy Bitcoin, and you can move Bitcoin to a self-custody wallet immediately. Whereas if you buy like on Coinbase or Kraken or one of the exchanges, they don't let you move it off the exchange immediately. There's some type of manual review that takes place. So I like the Cash App for simplicity and for convenience. There's also peer-to-peer networks like BISQ, B-I-S-Q, that allows you to buy directly from other people. And in our network in the Phoenician League, we also have a private network, the Bitcoin Bay guys we've got guys who are constantly buying and selling Bitcoin directly peer-to-peer, which was the original idea, to get rid of the intermediaries, to not rely on the banks or the exchanges or whoever, and just deal with each other. And that was the original vision. But those two things, it's very easy to systematize, and just every time you get paid, buy a little bit of Bitcoin, buy a little bit of gold. The other thing about building a financial foundation, though, and we have you guys as the experts, is IBC. Oh. And I believe very, very strongly in the infinite banking concept, which is creating cash value life insurance contracts that are set up in a very specific way, which enables you to do a couple things. Number one, you have it's life insurance, so you do have a death benefit, which creates estate planning things that you can do, allows you to build over time your kind of your family bank and that type of thing. But that's not the initial reason why we do it. We do it to warehouse cash in a way that it's outside of the financial system in a sense, but it's adjacent to it. Because when you buy an IBC policy, it does take several years to break even, but you get to the point very quickly where you pay your life insurance premium. And we were talking about Dave Ramsey earlier. And Dave Ramsey says, oh, yeah, just buy term and invest the difference. And the assumption is that buying insurance is an expense. If you do it correctly, buying insurance is not an expense. It is saving money. Because you get very quickly to the point where you pay your life insurance premium and you actually immediately the next day have more cash value available to you than you just paid. So, for example, I have policies for my kids that are like $3,000 or $4,000 a year. And when I make that payment every year, I do it annually, and I pay $3,000 to the life insurance company. The next day, I've got like $3,500 in cash value that I could access immediately. So I made $500 by giving the life insurance company $3,000. Takes a little bit of time to get to that point, But that is the nature of it.
4 years.
However, if you look at a legal standpoint, that's not money. It's not treated as money. That what you have as cash value in life insurance is equity in your life insurance policy, which is legally protected. If you were, for example, if you were sued, people can't force you to sell your home to access your equity in your home in the same way they can't force you to sell your life insurance policy to access the equity there. You know, a couple of years ago, we were kind of worried about this thing called unrealized capital gains taxes and wealth taxes and all that. I'm not worried about that stuff at all right now. But we were at one time. Well, life insurance, cash value life insurance would have been perfectly resilient to that because it exists outside the system. Number one, there's no database. There's no national database that says, you know, Joe has X dollars in cash value life insurance. I guarantee you there's a database for bank accounts. Guarantee you. That's all fed into a database, I'm sure. Okay. But cash value, it's outside of that realm. But it's treated, you know, it's a legally protected in a sense. So that's rambling a little bit. But I think IBC is a huge part of creating a financial foundation because that gives you cash that's warehoused somewhat outside of the financial system. But there's a guaranteed minimum rate of return, right? And it's not big. But your money grows every single year, and the compounding is uninterrupted.
It's not big compared to what you can get in an investment sense rate of return, but it is big when you compare it to anything else that is similarly situated, like a high cash value savings plan or a money market plan or a CD, because it also comes with all these other benefits. Like you talked about the protection, it comes with accelerated riders for health issues that cover some of that protection issue. Like you said, it's safe. It has guarantees, guaranteed level premium, guaranteed cash values, guaranteed interest rates. But not only that, it tackles two components of that protect, save, and grow. Like when I drew that out with the two parallel paths, the liability insurances are going to be everything people are familiar with: umbrella, car, vehicle, home insurance, et cetera, business insurance if you have that. Your disability insurance is going to be a separate thing that doesn't give you that equity. Your life insurance, to protect against that third possibility of death there, it provides the protection to your family that you need to ensure that it kind of completes the plan if you have human life value, meaning what your economic worth is with the remaining productive years of your life. So if you're 35, that's 30 years based on the standard American metric. So you're going to protect against that loss of income for your family, and at the same time have what could be the absolute best savings component in anywhere that you can find in any other product. So that one in particular kills two birds with one stone. And when we talk about the protection side, whole life versus term insurance is the only one that's going to match a guaranteed event. We're all going to die with a guaranteed outcome. There's never been a whole life insurance policy that has not paid when somebody's died. So they're not going to contest it in the same way that, like, something happens in your house and the first thing the insurance company wants to do is see how you were negligent and how they cannot pay it. It is going to pay upon death. And there's a couple of little situations where it may not, and those are all spelled out in perfect English, such as they all have a suicide exclusion. If you commit suicide in the first 2 years of starting the policy, it won't pay. It'll just pay back the premiums. After 2 years, it'll actually still pay. So those exclusions of where it could not pay are minimal and extremely well spelled out, and anybody that reads it understands it makes sense to them, and it really protects the industry. So killing two birds with one stone. That's why we think it's the greatest foundational asset you can have, and
you can access the cash value that you build up.
Talk about it too, like the ability to access that and use it for the living benefits. It should really almost be called.
It shouldn't be called life insurance. It should be called something else, right?
Something else. See, like Nelson Nash and his famous book, Becoming Your Own Bankers, said it's like banking with a death benefit thrown on top, because it has all these other living benefits that you can use throughout your life, and it's a phenomenal foundational asset that we can build wealth with, which is important. It's an and asset, as some people call it. So you can do this. And
just to quantify that, I have taken loans against my cash value life insurance to buy investment real estate, to buy investment properties that create cash flow that then enable me to pay back the loan. But the thing about the loan is there's no repayment schedule. You don't actually have to pay it back. You could never pay a dime, and that would not be a problem with anybody. But you know, if you're wise, you do pay it back because it builds your equity back in the policy. It's very advantageous as well. The loan is not like a bank loan,
Right.
where it's compounding daily or however it's structured. It's a simple interest loan, such that, correct me if I'm wrong, guys, but I believe that if you pay your loan back within the calendar year, I don't think you're even charged interest, right?
You are.
You
Is
are.
that
You
correct?
are.
You are.
It's
Okay.
not a simple interest loan. Simple
Okay.
interest would be you borrow $10,000 at 10%.
Right.
After 1 year, you have $10,000 or you have $1,000 of interest, and then after another year, you have another $1,000 of interest. The principal stays the same. This is a compounding loan.
Okay.
It's not simple interest in the sense that that balance stays static, but unlike a conventional loan, it compounds once a year. And if you pay, so basically, in that example, just for simple numbers here, 10% on a $10,000 loan, after 1 year, you're going to have $1,000 of interest. If you paid it off at the 6-month mark, you would have $500 of interest. And so, and as you make payments, because if you were to draw out, for instance, draw a box with 5 years worth of car payments, 60 payments, 60-month payments, 5 years, and you take a box, you can draw a line across the box horizontally that's going to represent the interest and the principal component. So every time you make a principal payment, it goes to those two different components at whatever rate is determined, right? Or you take a mortgage and it's got the curve, right? The front-loaded interest. So in the early years, you're paying mostly interest. In the later years, you're paying mostly principal. But you can look at that and you could see where that line is, and that's the amortization of it. When you make payments to those loans, they go partially to interest and partially to principal. You could opt to, on top of that payment, make a principal-only payment that goes solely to the principal. With a policy loan, your repayments go exclusively to principal. So let's just take those numbers again. Let's say $10,000 loan at the 6-month mark, and we're going to keep 10% interest, even though that's above the limit you could possibly have. That's above the insurance company's caps, but just for easy math, you have a 10% interest. And so at the 6-month mark, you pay half the loan back. So they're basically going to take, for 6 months, you had a $10,000 at 10%. So that's $500 of interest that you accumulated over the first 6 months of the loan. For the remainder of the year, to the 1 year policy or the loan anniversary, that 6 months, you're compounding $5,000 at 10%, right? And so your net effect, if you did that at the 6-month mark, you paid half the loan, your net interest paid on that is going to change, right? Because your total volume of interest is going to be different. Whereas with the regular loan, you're compounding monthly and payments are amortized across principal and interest. So those are two powerful factors there, but those don't hold a candle to the most powerful factor you said, which is that the policy loans are not required to be repaid because they will be repaid upon death if they're outstanding. And that gives you the power of something like low stress trading.
Death benefit that you receive is all.
Right. And so like low stress trading, you're making
fully
68%
collateralized loan essentially is what it is.
Exactly. And the collateral is guaranteed. So with my policy, with my wife and I, her policy is our emergency fund. We don't touch it. We don't invest it. That is our living expenses for this time. If I'm not making income, we're living off of that. In the meantime, it'll multiply into a death benefit. It's growing cash value. It's got all these benefits, tax-free, everything. My policy, I invest. And so I try to keep my policy pretty much levered out because I don't need it for living off of. That we have a separate bucket for that. That's my wife's policy. There's no reason for me to pay off my policy loan right now when it's earning 1% a week in low stress options. What I choose to do, since I'm in control, I'm the banker and I control the repayment terms, is I pay off the interest. I log in once a month. If I have a $10,000 loan balance, I log in once a month. And if it's $10,027, I'll pay the $27. I trim the interest off and I consider
you're
that
paying
interest
every month to keep it from
Yep.
compounding.
Yep. And because of the
Interesting.
structure of this loan,
Yeah.
I could do that once a year for the exact same effect. You
And
can't
that's
do the
what
same
I've been
thing.
doing is paying the interest once a year. I did not think to do it once a month though.
Well, you're not saving I'm not saving myself any money by doing it monthly because again, all payments. It's
Because as long as
it
you're paying
is-
that calendar year, right?
right. You're
Okay.
gonna. Yep. It doesn't matter as long as you keep that because if I look at my whole year, my principal remained at 10,000 for the whole year because it doesn't compound monthly.
Okay.
Your principal remains 10,000 for the whole year, so our interest paid would be the same. I choose to do it monthly, but I consider that monthly or annual interest charge as the carrying cost to allow me to invest the 10,000. So I let that 10,000 grow. there's no point right now for me to pay back that loan because I would just want to take it right back out and put it in low stress trading or in another investment. But I have full control over the repayment terms of that loan. And so it's super, super powerful.
It's amazing. It's an amazing, amazing vehicle. And that's why I really firmly believe that it's a solid foundation for any personal financial plan, because it could be anything. You build this cash value, you can invest it in anything. You could buy gold, you could buy Bitcoin, you can put it in trade options. You can do anything. Buy real estate, which is what I did. Anything in the world. So it's not, you don't have to make this either or decision. It's like, we're going to do both. Let's do both.
And when Nelson, who kind of brought this as a lifestyle plan, when he brought this to public, he used to always say, cash doesn't find opportunities, opportunities find cash. It's the opposite of what most people are thinking. And so what it does is a savings plan, because you're paying your premiums annually, monthly, however you pay that, over time, you're building this access to capital that you have. And when you have, and I found this to be certainly true, like when you first read that, you're kind of like, okay, like, well, I don't have a lot of capital, so I don't know what you're talking about, right? It's just this pie in the sky idea. And then all of a sudden I have a few $100,000 in cash, not all of a sudden, but over time I have a few $100,000 in cash value. And oh, cool. Or, I have my personal example that a lot of people have resonated. I just had a call the other day with somebody that was listening to the story on our podcast, and they were like, that's exactly what I want. And it was the fact I moved into a new house, and 2 months later, a 5-acre parcel behind me, and I have nothing but farms behind me. And then there was this little 5-acre chunk owned by a gas company. So they were selling it, and builders were looking to come in. I had this beautiful view 2 months after I move into a house. So you know how that is.
Yeah, don't let the builders
get it rain. It's like, hey, we got to get new curtains. Hey, we got, you're just spending money in the first few months when you move. But this property comes available, and I was able to pounce, and I was even overbid by the builders. But because I could close fast with cash and no contingencies, I got that acre. So it's like that opportunity 10 years ago would have been something that I would have said, man, I really wish they wouldn't have built those houses there. Yeah. And it was only
but now you're in
capital
control.
Base. And what most people are doing in the standard financial planning is you walk in, you get a corporate job, let's say, you go into HR and they say, what do you want to allocate to your 401k? So you're immediately in investment mode. A lot of times straight out of college, before you've even saved a nickel in your life, you start putting your money straight into investment mode, of which you have no access to. And so when an opportunity that requires quick cash comes up, there's nothing you can do about it. You could have $1 million in that thing. And if you've never saved appropriately and you've never built capital, you can't take advantage of anything. And this is just,
that's why the financial foundation,
like you said, investments, purchases, things like that. Land, I'm not going to make any money on that anytime soon. I might do some beehives next year.
Yeah, but it's not about the money, though. It's not, you didn't make the purchase to make money.
Sense to me,
because some things do not have monetary value. They have sentimental value or utilitarian value and all those things. And we're very clear about that. Like we specialize in money and finance and investing. I think one of the things we share in common, like, we don't care about money. I don't care one bit about money, man. I don't do any of this for money.
It's money can buy.
It's the freedom and the security and the things, that money can buy. And that's all that matters. Nothing else matters. And it's not for me, it's for my family,
Yeah.
And if I can help the community, I want to do that too. And if I can help people, that's what it's about. That's what it's always been about. But people get so, people get so lost, man. People get so lost, but it's really not hard. It's very simple.
Yeah, when you remove the focus on protection and saving, I think it's such a worthwhile activity to think about, what if I don't wake up tomorrow and your chessboard looks exactly like it does right now. You don't get to make any moves. You're frozen in time right now. Think through what is going to go to your wife, what's going to go, like, what's going where. Is that even sorted out? Is that efficient? Is that going to be through probate, or is that going to be through a trust? And is the amount satisfactory for the things you need? So it always comes back to what we're leaving behind and who we're doing this for, which is our families. But one more powerful point I think that's worth emphasizing. I feel like we're preaching to the choir, because your onboarding process includes an IBC education. All of our clients, obviously, it's IBC education. But just remember, when we're talking about, Brian mentioned this is an and asset. So people say, why would I put money in here when I can go invest in the market? Well, you can put money in here and then go invest in the market. And when you do so, you got to compare, where does that money come from? If you have money sitting in a savings account and you put it in the market, it's no longer in your savings account. It's earning for you elsewhere, hopefully out of your control, but it is hopefully making money in the market, but it's not in your savings anymore. When we leverage our cash value for that policy loan, we're not touching it. The full amount compounds. And so I have about 90% of my cash value loaned out in the form of 3 rental properties through Shane Thompson and RP Capital. I got a real estate syndicate, and I got my low stress trading, right? So those sources of income are generating revenue for me, but my cash value is 100% capitalizing and growing and compounding guaranteed, as if it's not touched, because it's not touched. The future value is touched.
Such an amazing thing. There's no other asset class where that is the case, where you're making a rate of return in one place, no matter what, but you can access that same capital to make a rate of return elsewhere, or just to buy a property for your family to live in, or whatever you want to do. But it does not mitigate the rate of return that you make within the policy. It's amazing. It's really.
And if I pass tomorrow, I don't want to leave my wife the RP Capital turnkeys that I have. One's in Indiana, Oklahoma, and Pennsylvania. I don't want to leave my wife 3 turnkey rentals, little single family rentals that are cash flowing a little bit each month in 3 different states with 3 different property managers and 3 different mortgages. And then the rest is financed through my policy loans. Like, I don't want to leave her that. I'm going to leave her that through the trust, but I'm also going to leave her what that cash value is that funded the purchases of those properties. Yeah. It's going to multiply many times over, self-complete in the tax-free death benefit. So she'll get that. So she doesn't have to worry about fire selling properties or trading options or any of this other stuff that I'm doing for us.
She didn't want none of that stuff. I promise you.
No, she doesn't want
like my wife. She didn't want none of that.
Yeah. Yeah, it's thinking more comprehensively and really going through the exercise of what if I don't wake up tomorrow? And if you wouldn't be comfortable putting that on paper, exactly what is going to happen and where it's going to go, one, if you can't define that and write that out in detail, you need to have. Well, I think you need to be talking to some people. And two,
that's something I did, was write instructions to my wife. Like, if something happens to me, here's what we have, here's how to access it, and here's what I think would be a good idea for you to do. You can do whatever you want because I'm gone, but here's what I think would be a good idea for you. So, but
and if you don't have that
instruction manual to where she, if something happened to, and I'm cool, like, and I make sure every time, like, if I've got to go out of town, I'm like, hey, you got the instructions? I make sure before I leave the house, she shows me the instructions so I know, okay, she's good, kids are good, something happens where they're going to be okay. And I think that's important, because
if you don't have that,
you don't do
you
that,
don't know where to,
then nothing else that you've done matters,
Yeah, you need to have a conversation with Legacy Lock.
Yeah.
If you haven't done that, or you can't do that right now, you couldn't yourself write everything out, or you don't know how to approach that, you need to have a conversation with Legacy Lock, and you can email us to do an intro there and get set up and get your trust going. And once you have the trust in place, if your wife wouldn't be happy with what is going where, like once those answers are on paper, she wouldn't be happy, you need to have a conversation with Joe, and you need to have a conversation with us or someone that you trust to put these pieces in place, because this is the most important thing. This is all that matters. That conversation right there, and that's protect, save, grow. Your index funds don't mean shit if this part isn't taken care of. Those come later. The last bucket I put money in is an IRA or a Roth IRA. If I just have so much cash that it can't go somewhere else, and I'm like, I don't want to buy more Bitcoin right now, or I don't want to buy more gold right now. I can't even really imagine being at that point. But for me, that last bucket is my qualified plan, right? But that you need to have this buttoned up, because none of those things down the road, those are all third order decisions to be made. Button this up first.
And they're the least important. They're the most. They're what everybody focuses on. And of course, I'm from the investment research industry, and that's what that industry sells, is the fun stuff, the exciting investments, all those things. And we have a framework for those. We engage in those, and they're fun, but they're the least important thing. The most important is building the foundation, creating the security, protecting what you have. All that is the first part. So we're at an hour. And I feel like we could talk for hours more, but I do want to, in case people have to drop off, I know a lot of times people kind of block off an hour for these types of things. So I did want to give folks, some actionable takeaways as for, what the next steps are. And I wanted to make sure that we got them your contact information for anybody who's interested in learning more about the infinite banking concept and setting up these kinds of policies that we talked about tonight. What's the best way for them to get in touch with you or to get resources from Remnant Finance?
Yeah, we're at remnantfinance.com. We've got, if you go to remnantfinance.com, you can find our scheduling link. You can email us at info@remnantfinance.com. You could go on our website. There's a little chat icon that'll just send us a text. We got our podcast on Remnant Finance podcast on Apple, Spotify, YouTube. So obviously a lot of our audience will be listening to it on that platform and know how to get in touch with us. But for folks that haven't, just start at remnantfinance.com.
I'm going to drop that in the chat because I just want to make sure, anytime I do one of these, I want to make sure that that we do have actionable takeaways, because I've had a blast just up here talking, but I do want to make sure that folks have an outlet for for the next step if this is something that resonates with you and you haven't explored it before. So I dropped remnantfinance.com in the chat, and I'll also add for the Phoenician League for our investment strategy group, we're going to open up our doors for the last time for 2025, and we're going to open up our doors through Christmas Eve. So I'm going to drop a join link into the chat for the Phoenician League. We've got a massive financial education platform that starts at very basic personal finance, and we explore the monetary system and how that works, and then we kind of get into asset allocation. We get into some of the more advanced investment strategies, and we've got, guys, I'm working on some material for the options trading system as well for the Phoenician League. I hope to have that before New Year's. I hope to publish it. We'll see. I've got some older information there, but the stuff I have is from like 12 years ago when options were mostly quarterly and the more liquid companies were monthly. And now we've got to the point, as I think we've alluded to tonight, we've got to the point where the most liquid companies are trading weekly options. And so if you can make 1% a week selling options, which is essentially selling insurance is how I look at it. Yep. It's insuring against an unforeseen outcome for somebody who, has a skin in the game there. But if you can make 1% a week, guys, it's in the 60s, about 68% a year. Yeah. So if you can make 68% a year, you are doubling your portfolio in less than 2 years. You're doubling your money in less than 2 years, which is amazing. And it's a very conservative strategy. So I've got some material coming on that. But we do a lot within the Phoenician League. We talk about investment real estate. We talk about mortgage notes. And our philosophy, it's very similar to the Protect, Save, Grow. We just kind of put it in different terms, and that is financial security first, and then financial independence. So the first thing we focus on is shoring up our finances, is securing our money, making it bulletproof, making sure that we have access to money whenever we need it, no matter what happens, no matter how much money they print. We make sure we're taken care of. And then we start to create extra streams of income for ourselves. And there's multiple ways to do that. And I think what we've kind of learned over the years is that the different advanced investment options, the different strategies resonate differently with different people. I don't think anybody I don't expect anybody to do all of it. I think it's more of those things. I think it's one of those things where when you learn about these strategies, there's probably going to be one or two that resonate with you more than the others. And that's, I think you guys put it, how do you frame it? Like your investor DNA, something like that?
Yeah, that's a common way. That's a common phrase. You have to figure out what you like, yeah. I have some also properties through RP, and I have some personal properties, and I now know that I don't love real estate.
Yeah, well, you had didn't you have a turnover and you had
that cost me so much money.
It had some repairs
wiped out, and
I've had that happen too, where it wipes out 8 months of reserves.
Ones are just a pain in the ass to me. Like I don't love it. For me, it's noise in life, and at some point I'll probably sell those. So, but I mean, it's it's a sure path to wealth. That's been proven over and over if you do it well.
It
But for
is.
me, I don't really like it. Like I'm probably,
Yeah, and if you don't like it,
yeah,
don't
I'm going to
do it.
walk away from that. There's so many other ways to get to build wealth.
Yeah.
Yeah. So we,
Yeah, so I just dropped in a link in the chat for the Phoenician League. We're going to open our doors through Christmas Eve at midnight. We've got all kinds of financial education, but really what I'm most proud of is we've built a really solid network where we have guys like Brian and Hans and numerous other financial professionals who we can get people in touch with just to have conversations, consultations, like not, it's not a sales network. We have vetted professionals who are just good guys who are willing to talk to people about, whatever their area of expertise is and about whatever the area of need is. And so we help with implementation. And so any of the basic stuff and the advanced investment stuff, we help people implement it. We actually talk to people, which coming from the investment research world, that's actually rare because nobody wants to talk to you because they're afraid you're going to sue them. And we are willing to talk to you. We have not only I'm available in the membership every day for our members to chat about anything, to answer questions, to help grant whatever insights I can. But we also have professionals who are experts in certain areas. We've got a great tax advisor. I know you guys use you work with Neil too, who's just a wizard, absolute wizard. We've got a lot of tax strategy that we do. We've got a great tax advisor. We've got estate planning, asset protection attorneys. We've got insurance guys, including Brian and Hans on the life insurance. I'm learning now about the disability insurance side, and it's really become a point of interest for me. It was a blind spot, but Brian put me in touch with a gentleman who I've got a call tomorrow to kind of learn some of the nuances, and so we'll have some more material on that for folks that we'll put out in the Phoenician League. And we do monthly calls as well. You guys have both been part of our calls each month. We're going to start doing 2 calls a month next year.
nice.
We've got a monthly newsletter that we put out. I write a lot about macroeconomics too, which I'm a geek on that. Hans, I know you're a geek on it too. I don't know if people like it or not, but I enjoy doing it, so we're going to keep doing that. But anyway, Phoenician League. So we've got that there. I'll just say we've got a lifetime. We do annual, monthly, and lifetime subscriptions for the membership. Annual and monthly obviously are what they are. The lifetime is just a single pay, and that's for people who are like me and have way too many other subscriptions and just cannot justify to their wife taking out another one. We do have a one pay option. Right now, it's less than what is it, like 2.5 years, less than 3 years, whatever it is. It's under $3,000 for the lifetime pay. We're going to raise that in 2026. So this is going to be the last opportunity to get in at the current lifetime price if anybody's interested. PhoenicianLeague.com/join is there. And again, for anything related to IBC, Hans and Brian, Remnant Finance team, these guys they are way smarter than me. They are supreme professionals. They know a lot about other areas of finance and investing too. I know they do great work for their clients. So anyway, those are our actionable takeaways for anybody who's looking to kind of get more into it in 2026. And from there, I see we've got some questions coming in. Guys, do we want to, is there anything else you want to chat about or talk about, or should we just open up to questions at this point?
Now, the only thing that I had when you were talking about, having the instructions for your family of what to do, we actually had an episode where we talked about heritage over inheritance. And I think that is something that needs to be talked about more in our community, because we're always talking about money, but what's the whole reason that I'm trying to build wealth? And it's because I want my bloodline to be stronger than what I received, and to create that heritage so that we can have a family that continues to create value in this world and continues to thrive and expand. And really that's the number one goal, is like, what are you doing to ensure that you're going to have a strong heritage? So put your focus there first. And the point of all of this is to back that up financially, because it is one of the major parts of life. One of the 5 pillars of life that matters is the financial
Yeah.
aspect. But center it around something, not the greed and the accumulation, like you kind of alluded to. It's not
Yeah.
about love of money.
It's
It's
not,
about
yeah,
what
it's
you
not
do
about
with
any of
that
that.
money, you know?
Yeah, it's about being a good
Yeah.
steward. And part of that is passing on values. You know, I think as a society, and we're Americans here. I don't know if we have anybody from other countries in the audience or not, but as Americans, I think we have done an awful job of passing down just our general and American heritage, but also our, family specific heritage as well. Like we've outsourced that to the
We
government
have.
for the last 100 years. And look at what they've done with it. Look at our culture, man. Look at what exists, and we could talk about this for
Oh yeah.
hours. But I'm like, you know, it's not. I'm very much a live and let live person until you try to parade something in front of my kids,
Yeah.
and then we got a
Papa
problem
Bear.
because the kids are they're in my stead. They're in my care, right? That's me. That's what I've been tasked with, and I believe this firmly. God entrusted me with these kids. And so when you cross that line, that's a problem. But you see some of the stuff that's happening in our schools. You see some of the stuff that's paraded around in front of the kids, and it's like, I mean, I'm not naming anything here. We could talk for hours about this, but we have done a very poor job at passing on American traditions, American values, American culture, and family-specific culture because we've outsourced
We
it.
have.
And that's that's the big focus. The very last thing, if you go through the Phoenician League program, the very last video course curriculum thing is becoming a steward of civilization. And that is why I've done everything for the last 5 years of my life. That encapsulates everything. It's about we should really do a better job of making sure that we are, number one, contributing to a productive society with good values. And I say good values, some of that's subjective, but some of it's not. I mean, we have Judeo-Christian values, which is centered in the golden rule, which is the easiest darn thing in the world. Don't hurt people, don't take their stuff. Treat people the way you want to be treated. It's the most basic thing. But it amazes me, and I've been, my experience in the investment research industry, I see people who don't live those values.
Yeah.
People with all the money in the world, and they do not live those values. And I'm like, man, but you shouldn't have any cares in the world, yet why are you being so petty?
Yeah. And back in the 70s, we're going to get way off the topics here.
Yeah.
In the 70s, what do you think the average time that a family spent from meal prep through sitting up was?
I'll just throw a number out at you. I don't know, but I would say 3.5 hours. That'd be
It was about 90 minutes, but that's 90 minutes a
Okay.
day, because that was a
1.5.
dedicated
Okay.
thing. Everybody wasn't running around doing,
Yeah.
all these other
Yeah.
extracurricular stuff, right?
Yeah, they're
What
not
do
on
you
their
think the
screens
average
and
2025 time is that families get together around dinner?
12 minutes.
It's 11. That was really close. It's 11.
Almost got it.
11 minutes.
I had too much confidence.
Like you think about, like, we're talking about these values that you want to instill, and this doesn't even matter for anybody that's listening. Like, even if you have grown children, it can still be impacted, because even if those days are behind you, like, how can you impact them and grandchildren? If you have kids like we do in your home, like, make a commitment to this. Like, the place that you are going to become friends with your family and get to know them and build connection is around the dinner table. Like, that's where you can sit and talk and build traditions and start that. But when we spend no more, an average of, which means a lot of days that's 0 if it's an average of 11. But if we're
Right.
spending 0 quality minutes with our children, how can we have a good heritage? And with our family, or even if you don't have children, even just with your wife, invite other people in and their families so you can share your values with them. Have more dinner dates, whatever it is, with other people and their kids. And that's what's really important here. And everything we do in the protection, save, growth, and money is just to enhance that.
Yeah, that's just a beautiful thing. You start in your locus. What is it? Locus of control, locus of influence, whatever it is, nexus of influence. You start there, and then you just expand out. And the reality is, none of us can get that far out. Like, everybody worries about national politics and all this stuff. We can't control any of that. We can control some, but what we can control is so much more important. And if everybody focused on what they could control and did their best, and whatever that is, like, it doesn't have to be the same thing for everybody, but it's just, injecting those values and trying to be a good steward of civilization. That's what drives me. And I say that as a father because probably if I didn't have the kids, I'm just like, well, man, I'm going to die anyway in 20, 30, 40 years. So what's it matter? But I've got these kids. So now it's like, well, shoot, I got to make sure their world's not screwed up,
Yep.
And so
New perspective.
anyway, that's why we do what we do. We want, we believe in the traditional American values. We believe in the family unit. We believe that things matter. There is truth in this world. There is reality in this world. This is not, I see a lot of the nihilistic stuff today where they're like, oh, well, truth is just what it means to you. And I'm,
there's real
no,
truth.
No, there's right and wrong.
Absolutely.
There's truth and lies. It's very very clear to see. So anyway, that's rambling. Hopefully I didn't run too many people off.
But that's part of what we want to do at Remnant Finance too, besides establishing you with that good foundation, teaching you how to utilize the infinite banking, providing that protection, providing that savings, or teaching you how to provide that savings and protection for yourself. But we also, a core value of ours is to help people think multi-generationally. Like, how can we help you become a mentor family that just expands that vision to the people around you and continue to grow so that your kids' floor is your ceiling and your grandkids' floor is their ceiling, and going on and on and on.
And if everybody buys, we didn't even mention this. I bought IBC policies for my kids when they were very young, and the policies are cheap. When they have kids, and I hope they do, we'll see. They're still young. My daughter's 11, my son's 7, so this is years down the road. But if they have children, the very first thing I'm going to do is buy IBC policies, and the policy I buy is going to be way bigger than the one I bought for my kids. And if everybody did that, you just buy. It takes one generation.
You're going to have 30.
It takes one generation to start it, and just buy it for the kids, buy it for the grandkids, And then all of a sudden, then you get into some more advanced estate planning, and you need to have some structures in place, and you need to have some understanding in place. But if you are dedicated to this, you can create an environment where within one generation, your family never has to worry about money again.
And that's called a high quality.
The rat race is gone.
Yep,
it's gone.
Yeah.
And now it's easy to say that, and there's going to be we're all human, and we all have flaws and all these things, but theoretically. You get rid of the rat race, and now all of a sudden, if you can convey, these types of values that we're talking about, we can create a world where everybody's just like, trying to just create a great world, And I don't know, man. It's really should not be. I don't think it's that hard.
Yeah.
I don't think it's that hard. It's just one generation has to start it. But that started it's not only financial, it's also conveying the values and what's important. So anyway, that's that. So, what have we left out? And if anybody has any questions or comments,
Bikram's question there about just your subscription model.
Okay, yeah. Sorry, I'm terrible.
If I do a monthly subscription to Phoenician League, can I switch to yearly or lifetime later?
Yeah, absolutely. Absolutely. You all you got to do, if you sign up for the Phoenician League, you're going to get my email right away. Reach out to me anytime. We also have an admin inbox too you can reach out to, but just reach out to me and we will accommodate. We can upgrade to annual membership. Make sure you get the discount too. I didn't even mention we do a 30-day money back guarantee. This is a labor of love for me. It's a passion. I've been just honored and blessed by the feedback that we've received. So, if you come in, if you join, check it out for 30 days. And if at the end of 30 days, you're like, man, you know what? I don't know about this. Just reach out to me. We'll refund you. We'll cancel the membership. It's not going to be a pain. Everything we do is about treating people the way we would like to be treated. Because I think we've all probably at some point, signed up for something that was misrepresented, and then we get in and we're like, this kind of sucks, but then when you try to talk to somebody, you can't get in touch with anybody. Like if you have any issues at Coinbase, good luck talking to somebody. And I love Bitcoin, but Coinbase has their customer service is non-existent, and I know that because I finally convinced my old man to buy some Bitcoin. But then he had this thing, and he had to get in touch with him, and he had a stroke, and now he can't talk. And then it's like, this whole thing, and I'm over there trying to help him get in touch with Coinbase, and it's impossible. So anyway, that's neither here nor there. All I'm saying is we're going to treat you the right way. 30-day money back guarantee. You can upgrade to annual if you like, upgrade to lifetime if you like, whatever. I'm just thrilled anytime somebody takes an interest in us, and that's, we're doing this because we want to do things right, and we want to seed value into the world. That's what this is. So yeah, that's it.
Well, it looks like that's
Robinhood is the king of
questions we
ghosting
got.
customers, Diana. Yeah, I am not a fan of Robinhood. I am not. They also, by the way, I don't know if anybody knows this, Robinhood sells all of their order volume to Citadel, which is a hedge fund. So every time you make a trade on Robinhood, before they execute their trade, they send it to some jerk at Citadel, and he makes that trade before you, and he makes like half a penny or 1 penny or 2 cents on your trade by buying it first and then selling it to you at a higher price. And yeah, it's not the worst thing in the world. There's been way worse things, but it's also not really. I mean, I don't think that's ethical, and that's I don't know if they disclose that anywhere, but that's exactly what they do. They sell order flow.
That's how they keep their fees low and make themselves.
That is how they keep their fees low. So I'm a little hesitant because it is nice to not pay commissions on trades. So if you pay, 1.5 cents more for every trade, that's probably better. I mean, when I first started, we were paying like $6.99 a trade or something like that. So maybe it's better, but but that's what they're doing. So just so you know.
Well, I think that's all we got as far as questions. Yeah, I think we're about an hour and a half here. So
no warning. Okay, cool. Well, I just want to thank you so much for setting up this joint session here. What I hope is that this will create the opportunity, maybe that we could get together after the holidays and do maybe a session where we talk about more advanced investment strategy, and maybe get into more advanced, whether it's estate planning or whatever, just a more advanced session. I know we kind of focused on the foundation today, and I think that's important. And for anybody who's looking at 2026 and thinking, well, I'm going to do better this year, and I think that every year. So that's not I say that every year. I got to sit, it's on my calendar for me. I block off a couple hours just to sit down and think. What went well. What should I do better? Because I think we can all do better at something, and probably at lots of things. I can certainly do better at lots of things because I fall short in lots of areas. But anyway, I just wanted to focus on the financial foundation today. But I do hope maybe after the holidays we can organize something like this again and get into some of the more advanced stuff if you guys will be open. After the holiday. Yeah, I say holidays. I'm including New Year's too, because I take 3 days off a year: Thanksgiving, Christmas Day, and New Year's Day. So I consider New Year's Day a holiday. But you are right; it is not on the same.
We're slashing holiday season from the remnant vernacular. It's not a thing.
I'm with it. Sorry.
My cool thing is we talked a little bit today about how you can utilize like the whole life insurance via infinite banking to do other things. We should run through like a little case study of what that looks like to, for example, buy a piece of real estate with utilizing your cash value and how those two assets.
Yeah, I'd be happy to share my stuff too. Like that's exactly what I did, and that's another thing too. We're up here talking. And everything we talk about, we've done. We're not talking about anything that we're just speculating or maybe that sounds good. We've done it. And we learned it from people who have done it for longer than us, too. That's the other thing, because that's how this stuff works. Like, it's got to pass down. The knowledge has to disseminate
generational thinking
through society. And that was one of, I think that was one of F.A. Hayek's big things, like the distribution of knowledge through society, which is why central planning doesn't work, because it's like everybody knows what they know and they can convey that to people around them, but it can't be really encapsulated. But anyway, I think that would be great, man. We could do some examples, and that really illustrates the power of the IBC strategy. And by the way, if anybody has not, if this is new to anybody, if you have not watched the Nelson Nash documentary, I Am Nelson Nash, it is amazing. It's like I want to cry when I watch it because he reminds me of my grandfather. And he passed away, by the way, a couple years ago. But a good friend of mine, Jason Rink, was the producer of that documentary. And Jason Rink, I don't know if you guys know him, he is the most canceled filmmaker in America. I think he's been canceled like 4 times now. But a good guy. I just saw him last week actually.
Nice.
Just a really good guy. He's done a lot of good work. But I Am Nelson Nash. You can get it right on YouTube for free. Mm-hmm. And now I'll probably go watch it tonight. But just a fantastic documentary.
Watch it with your kids, man. Get some family time in. Have them sit.
Yeah. Oh, yeah. I mean, when they see me coming, they're like, sometimes they're like, gosh, Dad, what are you making us try to learn today? But I got them watching. They're up there watching the Tuttle Twins. Like, my kids know more about monetary policy than I knew at 26 years old. Like, they're up there, like, they're talking about, and the fiat money, and it's just fake money, and they're printing all the money, and we need gold, and we need Bitcoin. And then they come to me, and they're like, Dad, how much Bitcoin do you have? And I'm like, well, son, I don't disclose the actual amount to people because, there's a thing called operational security, and you need to make sure that, nobody's trying to hack you or whatever. And he's like, yeah, Dad, I understand that, but how much do you have? I'm like, well, I promise I got some for you, buddy. I promise.
That's funny.
Nice.
But it's great. All right. Well, so see what Daniel said, 12 days of Christmas is the Christmas season. 25 December to 6th of January, which is the Epiphany, when the wise men presented gifts to the Christ child.
There we go.
Yeah.
That's the Christmas season. That is a thing. That is a thing we will wish you a well one.
We'll wish you a very Merry Christmas.
Yeah. Perfect.
Cool.
Well,
anything else for tonight, gentlemen?
Good to go, man. I enjoyed that. I'm looking forward to some more discussions in the future, some more like point in specific on different aspects of the strategy. But it's good to get our audiences together. Whoever's still hanging around with us looks like about the same as when we started, so that's good.
Yeah, and thanks everybody for coming to hang out with us tonight. Sincerely appreciate it, and we wish you a very Merry Christmas. And we're gonna have lots of fun in the new year. I have not been more optimistic than I am right now, as I have in a long time. This is the most optimistic I've been in a long time. For whatever problems exist, whatever challenges, I think we have a very clear path. I see a lot of trends that are very encouraging to me. So let's make 2026 a great year. And
that's right.
Yeah, and we'll get together maybe, I hope, in January, guys, and we can talk some more.
Looking forward to it.
Awesome.
Cool.
Well, all right, thanks,
we'll
everybody.
Leave it there then. Thanks, everybody.
Merry Christmas.
Yeah.
See y'all next time.
Don't say Happy Holiday to Hans now.
Do not do it. Do not do it.
All right. See you guys. Have a great night.
See ya.
All right. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.